You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Hi, everybody. I am back in my studio in Puerto Rico after spending the last couple of months traveling and back on vacation in Connecticut. And, I am recording this podcast on Sunday evening. We are going to release it live on Monday, probably late morning, early afternoon. So obviously it won't be live if I'm recording it on a Sunday night. The reason I am not doing it live, which is what I had been doing in the past, is because I found out that the reason that we had a degradation in the quality of the video had to do with what was getting lost by doing it live. So by recording it and then playing it, it's going to be a much higher quality. So we're going to do that tonight. Maybe next time, if I do it on a Sunday, I'll record it earlier in the day so that it can be released later on Sunday night in higher quality. Also, I do have 3 additional cameras that we're going to be using. They're not completely hooked up yet, so I'm not using them now. But soon we'll be able to have a lot of different angles. So it won't just be one close-up. You'll have some wide angles and some different ways to show the podcast studio. So I think it's going to start looking even better in the future. But for now, we're sticking with the one camera, but I am recording it. Although YouTube is going to, it's going to look live when it comes out. And that's because it shows up higher on the algorithms for YouTube. So if YouTube thinks it's live, then potentially more people will see it than if they thought it's recorded. But I wanted to make sure that my audience knew that I was actually recording it on Sunday night. And that means when you watch this for the first time on Monday afternoon or late Monday morning, if there's something big going on in the markets and I'm not talking about it, that's why, because I didn't know about it because I'm recording it earlier. Anyway, I want to start today's podcast by focusing on the gold stock market, because we had a big week in gold stocks, and I think it's a very significant week. And I really want to make sure that my podcast audience is invested in this sector to the extent that they, are, risk seeking. These are not for widows and orphans because there is risk. Although I believe the upside potential dwarfs the downside risk. And I think that, when you get a situation where it's so asymmetric, where you have so much profit potential relative to what you can lose, that's when you want to make a big bet. I mean, I think that's how people have made a lot of money in the markets over the years, is by waiting for these asymmetric opportunities and then going all in. And I think that is something you'd want to do with the gold stocks. Now, last week, gold didn't really move very much. Gold was only up about 1.3%. Now, that's in the spot market. There was some extra action in the futures market. Gold futures, the front month, I think, or December gold even, hit new all-time record highs. We didn't see record highs in the spot market. And the reason for that was that Donald Trump threw a monkey wrench into the gold market, because there were stories that came out that 100-ounce and kilo gold bars would actually be subject to tariffs. And a lot of those bars are fabricated in Switzerland. And Switzerland is subject to a 39% tariff. At least Americans are subject to that tariff if they import something from Switzerland. Well, if you import gold bars from Switzerland, 39%. That is a huge premium. And so what happened was, I think some of the shorts in the futures market needed to cover. They needed to buy back their contract because when you are short a contract, you are obligated to deliver the underlying metal if the long decides to, put in a notice that he wants delivery. Now, of course, most of the gold that trades on the COMEX is never delivered, so it's not a big deal. But anybody who is long one gold contract could take delivery of a 100-ounce bar. And that means that whoever is short could get assigned that delivery. And it means that the short, if they haven't closed out their position, now has to buy a 100-ounce bar and deliver it. Well, if you have to import that bar, you have to pay the tariff. You can't charge the tariff to the long because he's got his price locked in. As a short, you are obligated to deliver gold at, whatever price the long owns. He just has to pay the price that he paid when he bought the contract. And the short has to deliver the gold at the price he sold the contract, but now he's got to pay a tariff. And even if he wasn't going to have to import the bar from Switzerland, you would figure that all 100-ounce bars or kilo bars would start to move up in price because it was so much more expensive to bring them into the country. So I think in the futures market, you got a lot of short covering, which is what spiked the price to record highs without seeing that in the spot market. Now, I believe the spot market would have followed and made new highs probably this week, although it could do it. I mean, gold closed around 3,400. It's never hit 3,500. I forget what the record high was, maybe 3,450-ish or something like that. But what happened after the markets closed on Friday is the Trump administration backtracked, although they said it was all misinformation and that Donald Trump is going to be issuing an executive order that clarifies the fact that these gold bars are not going to be subject to the tariffs. But, I don't really think it was misinformation. It might have been a trial balloon that didn't go well. And maybe, after Trump was presented with some facts that he didn't like, he changed his mind and decided to say the whole thing was misinformation. But I doubt the stories would have run had the government not put out that information. They just didn't like the way the markets received the information. So they did an about face, which is something that is pretty typical of the Trump administration. I just wish they would do an about face on more things. I'm going to get into that in a bit, but the Trump administration is doing a lot of things that I think are wrong and unconstitutional and bad economics and should not be done. But let me get back to what's happening in the gold market. Or the gold stock market. So gold was up 1.3%. I mean, not a huge week. Silver was up more. It was up about 4%. But that's because silver was down 3% the prior week. So silver just kind of bounced back, recovered ground that it shouldn't have lost. But the real action was in the mining stocks. The GDX, which is an index of gold stocks, the GDX was up 10.7% on the week. That is a big move. The GDXJ, which is the juniors, was up 11%. And in fact, it took until Friday, I think, for the GDXJ to make a new, 52-week high or a new high since, 10 years, 12 years, whatever. But the GDX made a new high for this particular bull market, I think Monday or Tuesday. It took a while for the smaller stocks to catch up and eventually make new highs on Friday. But I think the fact that you're finally starting to see significant strength in the gold and silver mining companies, even without a lot of strength in gold. Gold did not have a big week, but the mining stocks had a huge week. And so I think this is really a sign that institutional money is finally waking up to what's going on here and allocating money into this sector. And we got a long way to go. I mean, these stocks are still substantially below their highs from 2011 when gold was at 1900. So, I mean, gold has moved up 80% since then. And, a lot of these stocks are, quite a bit lower now than they were then. And the valuations are ridiculously low. If you look at these stocks on a price to earnings ratio and a lot of other metrics that historically you use to value these stocks, and these stocks are at historically low valuations. And so I think this is not going to be lost on investors for long. You're going to see more and more money flowing into these stocks. And I think the returns are just going to get better over the years. Now, the GDX is up now after this 10% move. It is up 71% so far this year. Of course, the year's not even over yet. And you got a 71% gain, right? Investors, institutional investors, are going to notice this. They're going to start putting gold stocks on their screens, I think, for the first time. For all the hoopla around Bitcoin, right? Because Bitcoin's stole all the spotlight from gold this year, right? Everybody, Bitcoin, right? With the Trump making America the Bitcoin capital of the world. Meanwhile, he's adorning the entire Oval Office in gold. I mean, I saw some images of the Oval Office now, and there's just gold all over the place. In fact, I saw that Apple, Tim Cook came to the White House and presented Donald Trump with like a token of his appreciation, a plaque, a glass plaque. But the case, right, or the base of the plaque, he said was 24 karat gold. Now, if it's solid 24 karat gold, that's $1 million base. That's a great gift for the president, kind of, more like a bribe, because he was giving out some exemptions on tariffs on semiconductor imports. But Bitcoin has been getting all the attention. Well, Bitcoin is up on the year, but 24%. I mean, that's still a big move, although Bitcoin can crash, at any moment. But it's up 24%. But if you bought gold, gold is up 29% on the year. So gold, year to date, in the year of Bitcoin, right, gold is beating Bitcoin. And, with all this buying, and, a lot of the buying now is coming from these Bitcoin treasury companies. Now they even got Ethereum treasury companies. But it's all Wall Street piling into Bitcoin, yet it's not even doing as well as gold. But it's doing a lot less than the gold mining stocks, because you would think, hey, let me leverage a bet on gold. Maybe somebody thought that Bitcoin was a way to leverage gold, that they thought it was, supercharged gold 2.0. Well, it underperformed gold. What outperformed gold were gold stocks at 71%. Gold stocks even outperform MicroStrategy, which MicroStrategy stock, or strategy, they dropped the micro, although pretty soon it's just going to be micro because the stock's going to collapse. But year to date, it's up 38%, although the main reason for that is that it got clobbered in December. From the end of November, it's basically flat. But year to date, just for apples to apples, MicroStrategy is up 38%. You've done a lot better buying the GDX, gold stocks. And I think this is going to continue. And I think that a lot of people who took some of their gold chips and moved them over into the Bitcoin space, they're gonna move them back. They're going to realize that they're better off with real gold rather than this digital alternative, fool's gold. And that money is going to come back to the gold market. I don't even think it's started yet. I just think you have some new money coming into the space, but the money that left it hasn't come back yet. It can be hard to talk about not being able to get hard, but HIMSS is here to make things much easier. Their all-online process connects you with a licensed healthcare provider who can recommend personalized ED treatments from the comfort of home. Get a boost in and out of the bedroom with access to personalized treatments, including daily options for more spontaneous sex. Through Hims, you can access personalized prescription treatments for ED like Hard Mints and Sex RX Plus Climax Control. Hims offers access to ED treatment options that cost 95% less than brand names. New Sex RX Plus testosterone support includes tadalafil for better bedroom performance and zinc for testosterone support. With hundreds of thousands of trusted subscribers, Hims can help find the ED option that works for you if appropriate. Just fill out an intake form on their site and connect with a medical provider who can determine if treatment is right for you. The process is 100% online, which means no office visits and no pharmacy lines. No insurance is needed, and one low price covers everything from treatments to ongoing care. If prescribed, your medicine ships discreetly to your door for free. Start your free online visit today at hims.com/gold. Find ED treatment that's up to 95% less than brand names at hims, HIMS.com/gold. hims.com/gold. Actual price will depend on product and subscription plans. Featured products include compounded drug products, which the FDA does not approve or verify for safety, efficacy, or quality. Prescription required. See website for details, restrictions, and important safety information. You know, I have a gold fund, right, that Adrian Day manages it for me, the Europe Pacific Gold Fund. And my gold fund is only up 60% on the year. Now, I say only, I mean, that's still a great return for a little over half a year, but it's not as good as the 71% in the GDX. And people might say, well, Peter, why should we buy your fund, right? Why should I pay the management fees if you're underperforming an index? Well, it's because we're underperforming the index now that I think we're going to so outperform it over the next several years. Because the reason that we only have a 60% return year to date is because we have a significant percentage of the portfolio in a lot of very small junior mining companies. And these companies haven't attracted the institutional money yet. The money that's going into the sector is going into the big stocks first. Now, we own a lot of those stocks too, but we also have this allocation to these junior stocks that right now are dragging the portfolio. But in the long run, they're going to lead the portfolio because the next phase, right, the next movement is going to be into these smaller stocks. Now, you might think, well, why not wait until they start to move and then buy them? Well, there won't be any liquidity. It took Adrian years, many, many years of buying to get these stocks. It's not easy to buy size for these small companies. In fact, a lot of the positions we have were accumulated through private placements where these companies were raising money and they were selling stock. And so we would just buy it into the fund. Also, the fund owns warrants on a lot of these companies that are out of the money now and so don't really show up much in the NAV of the fund. But when these stocks really start to move, assets that really have very little to no value can be very valuable. So I think we have some huge future performances baked in right now because of all of these small stocks that Adrian was able to accumulate for us during the bear market. You know, these small cap companies had a hell of a hard time raising money. And so they had to, dilute the stocks. Nobody's been paying attention. But I think they're going to be some of the biggest winners. And Adrian is really good at knowing which small companies to buy and which ones to avoid, right? Because there's a lot of opportunities to lose money in the junior mining space. And the key to being successful is to try to avoid, the landmines and buy the gold mines. And I think Adrian's done a great job of doing that. And so I think this is a great time. People really should be loading up on my gold fund, EPGIX. That is the symbol for the no load version. You could buy this gold fund anywhere on any of the major discount brokerage firms. And look, if you don't want to buy my gold fund, if you just want to buy the index, you'll make money, I think. I mean, I think, it's going to be hard not to make money in the gold sector, right? I think this could be a huge historic bull market. So I think you make money pretty much no matter what you do. But I think you'll make more money in my fund because I think Adrian has done an excellent job of building this portfolio. And people can still take advantage of this portfolio by buying my fund now, because by buying my fund, we don't necessarily buy more of these companies. We already own big positions in these companies. And so it's not going to push the price up. But eventually, when more money goes directly into these little stocks, there's not going to be a lot of selling. And so the buyers are going to overwhelm the sellers. And I think you're going to see these little stocks moving up much more than the bigger stocks. It's just that the bigger stocks are moving first. And so that's why you're seeing that in the indexes, because those are the stocks that dominate. Even the GDXJ, which is supposed to be junior miners, even those companies are pretty big. They're not necessarily juniors in the true sense of the word. There's a lot of larger companies that are still included in the GDXJ. But also, it's not just gold stocks that are going up. It's all these foreign stocks. The S&P 500 is up about 9% on the year. But look at my foreign dividend payers fund, right? EPDIX. I'm almost up 34% this year. That's not an annualized rate. That's how much we're up as of, July 10th-ish or whatever the date is. 33.7% to be precise. I wrote it down. What's going on here is a major rotation, and it's actually a double rotation. There's a rotation out of dollars into gold. Central banks are moving away from dollars as their main reserve asset into gold. And this trend, I believe, is going to continue for many, many years. This de-dollarization trend is here to stay. And what Donald Trump is doing is going to accelerate the move out of U.S. dollars. But it's not just out of U.S. dollars and out of U.S. bonds. It's out of U.S. stocks. The world has been over-allocating into the U.S. stock market for more than a decade. Ever since really around 2013 or 14, around there, it's just been, all the money has been moved into the U.S. at the expense of the rest of the world. So the rest of the world is really stagnated as the U.S. stock market bubble inflated. What's happening now is the air is coming out. Money is being sucked out of overpriced U.S. stocks, and it's being reallocated into much better valued foreign stocks. That's why you're looking at a 33.7% return on my foreign dividend payer fund. And I think, again, this is the beginning, not the end of this move, that it's not just going to continue for the balance of the year, but for the balance of the decade and into the next. So you really want to have your stock market money that isn't in gold stocks, in international stocks, and you want to get out of U.S. stocks. Again, the symbol on my dividend payer fund is EPDIX. And, even my international bond fund, EPBIX, right? My foreign bond fund is up 10% this year. 10%, that beats the S&P. So without taking any stock market risk, just holding a portfolio of foreign bonds, you're up 10% on the year. Compare that to U.S. bonds. Look at TLT, which is a closed-end U.S. bond fund. It's probably the most popular closed-end U.S. bond fund. It is flat. You have zero return. So if you bought U.S. Treasuries on December 31st, year-to-date, you've made no money. But if you just bought my foreign bond fund, year-to-date, you're up 10%, right? So that even beats U.S. stocks. I mean, it crushes U.S. bonds. So this is showing you what is going on. Right? Most Americans are asleep. They have no idea that this transition is even taking place. They will probably, if not next year, the following year, maybe American retail investors will finally figure out what's going on and start to, move some of their U.S. assets into foreign stocks. But by then, of course, foreign stocks, I think, will be much higher relative to the U.S. stocks that they're selling. I think the sleeper is going to be the emerging markets. I have an emerging market fund. Symbol is EPEIX. And that fund is up 17% on the year, well less than my dividend payer fund, because the emerging markets, I think, are still, being overlooked in what's going on. But I think they're going to be some of the biggest winners. So I think that fund and other emerging markets are gonna kill it in 2026, because that's the year I think the dollar is really going to come under pressure. I mean, this is a bad year for the dollar, but I think next year is going to be even worse. Because that's where I think a lot of these chickens come home to roost. We're going to see the full impact of the tariffs, of the return of inflation. The Fed is going to be cutting rates. The dollar is going to be tanking. We're going to be mired in stagflation. It's going to be obvious. I talked on my last podcast about how bad the jobs numbers are, especially following all the historic revisions that we've seen to those jobs numbers. We're going to get revisions, I think, to the GDP numbers. The economy is far weaker than has been, advertised and perceived, and inflation is stronger. So inflation is going up, the economy is going down. Things couldn't be worse, I think, for U.S. investments, but they couldn't be better for international investments and for gold investments. I wanted to talk about a couple of things that Trump's been doing. One of them just happened. I mean, just before I started to record this podcast, I read an article about Trump getting NVIDIA and Advanced Micro Devices to agree to pay the U.S. government 15% of their revenue selling their products into China, right? 15%. And I guess if they didn't agree to that, I guess Trump was going to say, you can't even sell these products to China. And in theory, the reason that we would prohibit the sale of products to China was because of a national security risk. Well, clearly, if we're going to allow the sales to happen, but just force the companies to cut the U.S. government in for 15% of their sales, then clearly it's not a national security issue. Because if it was a national security issue, then we wouldn't allow them to do it at all. So to me, this is a backdoor export tax. We're basically telling these companies, we'll allow you to export these products, but you got to cut us in, with a big slice of your profits, which I think is unconstitutional on so many levels. First of all, it seems to me like it's extortion. That Trump is shaking down these companies and getting them to agree to this, right? With threats. Hey, we're not going to let you do this, but we will if you cut us in, right? Which they can't do. I mean, yes, there already is a tax, right? If NVIDIA, if AMD earns a profit, they already pay an income tax to the U.S. government. So the U.S. government already has a piece of the pie. But now they're demanding, or Trump is demanding and getting an even bigger piece. But he can't do that. Trump can't just levy taxes on NVIDIA or on AMD. Congress has to levy those taxes. Trump can't do it, right? And this isn't a tariff. This is like an export tax. But Congress can't even tax exports even if it wanted to. If you look at Article 1, Section 9 of the U.S. Constitution, which is where the U.S. government derives its taxing powers, Congress has the power to lay and collect taxes on duties, imports, excise. It doesn't have the authority to tax exports. It's not there. Remember, if the government isn't given the authority, it doesn't have the authority, right? The powers have to be expressly enumerated in the Constitution. And the founding fathers specifically left exports out. So the U.S. government can tax imports, which is a tariff, but they can't tax exports. Well, what they're doing here, what Trump is doing, is a backdoor tax on exports. Maybe he's saying, well, I'm selling an export license, which there's nothing in the Constitution that allows that either. the Congress or the president doesn't have the power to sell export licenses. But if the license is basically a share of the revenues, that looks like a tax, right? That's what a tax is. So all this is unconstitutional. I don't like the fact that Donald Trump is trying to basically micromanage the U.S. economy as if it was Trump Enterprises. In fact, that's what he's doing when he's turning the White House into Mar-a-Lago. You know, he's got those umbrellas now too on what used to be, the garden area, and he's now turning it into Mar-a-Lago, and he's got all this gold leaf and everything now all over the Oval Office, right? He's running America like it's, a Trump enterprise. I mean, maybe he's going to put one of those big T's up on the lawn there of the White House and just, but America is not a corporation. He is not the CEO, and he only runs the executive branch of the federal government. He doesn't run the whole government, but the government is not supposed to run the country. The country is supposed to run itself. We're supposed to be capitalist, free market, right? Trump is in charge of one of three branches of the federal government. He does not run the country, right? He is not a dictator or a king of America, and he just runs everything. But that is what he seems to be doing. Now, another thing that he's doing that I think is a huge mistake, if he actually does it, I don't know if he's going to do it. He could just be, just bluffing to help his friends, make a profit. But there was another big story on Friday. The Trump administration, leaked out that they really want to get the privatization done of Fannie Mae and Freddie Mac, and they want to sell the company or make it public by the end of the year. And, that caused these stocks to jump up maybe another 20%. These stocks are like $9, $10 a piece now. They were $1.50 before Trump won. And I talked about this trade before Trump did win, because there were all sorts of rumors that if Trump won, he was going to, release these things from receivership, recapitalize them, release them, and that they would be public companies, and people were buying them. Some of Trump's largest donors, big hedge funds, owned significant positions in Fannie and Freddie, basically to profit from what Donald Trump is going to do. But to the extent that he's able to do this, it's a horrible thing for the country. It is bad economic policy. And the only reason to do it is because donors to the Trump campaign and friends will make a lot of money. That's the only rationale for doing this. There is no economic justification for trying to do it. See, the problem is Donald Trump has said that he wants to privatize Fannie and Freddie, but he wants to maintain all the government oversight, and he wants to maintain the explicit government guarantee, which, if you're going to do that, then you can't privatize it. Because number one, the guarantee is no longer explicit. It is now implicit. There is a huge difference between implicit and explicit. Now, let me go back. I'm going to go over a little bit of the history of Fannie and Freddie, because a lot of people might not know. So Fannie Mae was started during the New Deal by FDR, and pretty much everything he did was bad, unconstitutional, shouldn't have been done. But Fannie Mae was started in 1938, and it was a government agency. It wasn't started as a private government-sponsored enterprise. It was a government agency. It was part of the U.S. government. And what it did is it bought FHA-insured mortgages only. So the FHA insured mortgages. And then Fannie Mae went into the market and bought those up, packaged them, and then resold them. And the idea behind that was, look, it was bundling them up and selling them in a more diversified pool. It was creating some more liquidity, but it was still a government agency. And it operated as a government agency, only allowed to buy government-insured guaranteed mortgages up until 1968. 1968 is when they changed it to a government-sponsored enterprise, right? And And that's when this implicit guarantee was created. Because if you went back and you bought any FHA mortgages, it said right in the prospectus, the U.S. government does not guarantee this, right? So the government told you, you buy these Fannie Mae securities, there's no government guarantee. We don't guarantee it, right? That's what the government said. Now, what everybody just assumed was, the U.S. government, they created this whole thing. It's government sponsored. Are they really going to let it go bankrupt? The markets didn't think so. So there was an implied guarantee, right? We don't think the government will let these bonds fail, right? So it's almost like the government was saying they're not guaranteed, but wink, wink, right? Yeah, we got you covered. Now, there was always a chance that the government wouldn't do it. So if you looked at the difference between Treasury yields and the yields on a Fannie Mae, you got a higher yield by buying the Fannie Mae because there was a chance that the government wouldn't step up, right? Whereas if you bought U.S. Treasuries, they had the full faith and credit, 100% guarantee, so there's no chance, right? The government's not going to let you lose money in Treasuries if you hold them to maturities. I mean, you won't lose dollars. You'll lose purchasing power. You'll get wiped out by inflation. But if you have, 100,000 in a U.S. Treasury, when it matures, the U.S. government guarantees you're going to get your 100,000 back. They don't guarantee it's going to buy anything, but they guarantee you're going to get it. There was no such explicit guarantee. You have 100,000 in Fannie Mae, who knows, right? It could default, you may lose, right? But the idea was the government probably won't let you lose. So that small chance that you still could lose meant a little bit more risk than Treasuries. Now, in 1970, it changed. That's when the government said to Fannie Mae, you don't have to only buy the FHA mortgages. You could buy conventional mortgages that are not FHA guaranteed. The only condition was they had to meet certain standards that were set by Congress to conform to what Fannie Mae could buy, right? And these conventional conforming loans. Now, the problem was over time, Congress kept lowering the bar, allowing Fannie Mae to buy or more and more mortgages that were in fact riskier and riskier. And also in 1970, they created Freddie Mac because they wanted Fannie Mae to have some competition in securitizing and issuing these securities with this implicit, right, U.S. government guarantee. Now, they all went bankrupt, as I predicted, in 2008. I was forecasting for years that Fannie and Freddie were going to go bankrupt because of the tremendous risk that they were taking. And when they went bankrupt, the government finally answered the question on the implicit guarantee. Everybody who held Fannie Mae or Freddie Mac securities was bailed out. Nobody lost any money. So it turned out that that implicit guarantee was in fact real, right? And when the U.S. government bailed out everybody, they basically took over Fannie and Freddie, wiped out to a large degree the equity holders in the stock, and they took over the company in conservatorship. And the government has been operating Fannie and Freddie ever since in conservatorship. And they have been making money because we're in another housing bubble, right? There's probably a lot of Fannie and Freddie loans out there that are going to eventually go bad, but they haven't gone bad yet because of, the housing bubble. But what Donald Trump wants to do now is recreate these government-sponsored enterprises, only worse than they were before. What he wants to do, and at least what they're saying, is they want to either take them private again, and private in quotes, because they're not really private. The profits are private. The losses are socialized. Although the U.S. government, as a major stockholder in Fannie and Freddie, would be getting some of those profits because the U.S. government would own stock in Fannie and Freddie, which again, I don't like. I don't like the U.S. government owning stock in private companies. I don't think the U.S. government should have any role in any ownership in any private company. So either they should sell the whole thing or sell nothing, because I don't think the U.S. government should be a stockholder in a corporation. But that's a whole different topic. But they're talking about either privatizing them, by themselves, or taking Fannie and Freddie and making one company out of the two and then privatizing that. But what Donald Trump says he wants to do is maintain the implicit guarantee, which isn't implicit anymore. It is explicit. You cannot sell these companies, privatize them and say, we are privatizing them with an implicit guarantee. An implicit guarantee can't be asserted. You can't say, hey, we don't guarantee these, but we do. Either you say we guarantee these or we don't. The implicit guarantee was a creature completely of investors. Investors on their own assumed that the government wouldn't let these obligations fail. The government never said that. The government said, hey, we don't back this. This is not guaranteed, right? The markets assumed it. But if we're now going to have a new IPO, you can't do that anymore. It either is or it isn't. It's black or white. So if Trump says, hey, we're privatizing Fannie and Freddie, and anybody who buys any of their securitized products, it all comes with a U.S. government guarantee, well, it is so much worse, because now Fannie and Freddie are basically issuing U.S. treasuries. Buying securitized mortgages, issued by Fannie and Freddie would be like buying a U.S. treasury, which is a disaster, because it would allow excessive risk taking, right? It's going to be worse than what happened prior to 2008. There is no justification for this. What should be done if Trump really wanted to do the right thing for the country, not just for shareholders of Fannie and Freddie who want to cash out, right? Abolish them completely. Get rid of them. The government should have no role in mortgage finance. I don't even think we should have the FHA. But again, why not just privatize that? If you're privatizing Fannie and Freddie, why not privatize the FHA then? If you think if the private sector should be doing this. Look, banks that already exist, companies that already exist, anybody can pool mortgages, right? That's what the private sector is doing. What do you think collapsed in 2008? Because the private sector was creating these mortgage-backed securities. They were pooling even subprime mortgages, right, and reissuing them. Fannie and Freddie wasn't even doing that, but they were buying them on the secondary market, but they weren't issuing them because they didn't meet the criteria to conform. So Wall Street, took over that. Well, Wall Street can do exactly what Fannie and Freddie is doing. The only advantage that Fannie and Freddie have is that they're doing it with a government guarantee, because right now, because these stocks are being operated in government conservatorship, we all know the government stands behind it. After all, they stood behind it before when they were private companies. Now the government's running them in conservatorship, so of course. But the problem is, if Trump privatizes Fannie and Freddie and says there is no guarantee, right? The government's got nothing to do with it. These are just two private companies that are buying mortgages and reselling them, that they're not worth very much. They can't even privatize it. The whole thing will collapse. And of course, without Fannie and Freddie buying mortgages and then reissuing with a government guarantee, mortgage credit would tighten. Mortgage rates would go up. There is no way to privatize Fannie and Freddie in a real sense, where the U.S. government says, we got nothing to do with these companies. You buy their securitized mortgages, you do it at your own risk, which is what they should do, then mortgage rates will go up, and the government won't make a lot of money selling them because they're not worth that much, because I think there are a lot of other companies that would eat Fannie and Freddie's lunch in a free market. I think other big banks would do a much better job than Fannie and Freddie. The only reason that Fannie and Freddie can compete is because of this government guarantee, because that means if you buy their mortgages, right, they're a better deal because you have less risk than buying mortgages of some other companies. Now, maybe the U.S. government can come out and say, hey, any company that securitizes mortgages is going to get a U.S. government guarantee. As long as you follow our rules, it doesn't have to be Fannie or Freddie. But of course, then they won't do that because that would take the value away from Fannie and Freddie because now there'd be more competition because everybody would be doing what Fannie and Freddie. So the only way to do this IPO and have any value is to say, hey, Fannie and Freddie, or if it's one company, even though it's private, it's a government-private partnership where the government stands behind everything. This is all U.S. government debt. You could just take whatever Fannie and Freddie has insured and just add it to the national debt because, the U.S. government stands behind it. But why should the U.S. taxpayer stand behind this? Why should you set up a situation where you have private profits, but you have public losses? That is not capitalism. That is cronyism. That is crony capitalism, right? That is everything that Trump is supposed to be against. But apparently, the entire presidency has to do with this crony capitalism. It's Donald Trump trying to cut deals, trying to micromanage these companies. Look, he's getting all these countries in these trade deals. Oh, I want you to invest money here. I want U.S. companies to, start manufacturing. I want you to build factories in America. I want you to do this. That's not Trump's job. Trump's job is not to tell CEOs how to run their businesses, where to put their factories. Yes, it would be great if they were building factories in America, but not because the U.S. government put a gun to their head and said, build a factory here. They need to want to build factories in America because it makes economic sense to do it. Because once upon a time, all the factories were in America. And it wasn't because U.S. presidents forced companies to do it. It was because it made economic sense for those companies to do it. Now, if it doesn't make economic sense, if companies are more competitive with factories abroad, then that's what they're going to do. What Trump needs to be asking is why. What is it about building factories in America and manufacturing in America that's so unappealing that all these countries, all these companies don't do it? Why did we used to lead the world in this manufacturing? Why did we used to be a major exporter of manufactured goods, the biggest exporter? Why did we have huge trade surpluses in the past, but we have massive trade deficits now? Get to the root cause of the problem and change that. Change the game so that companies want to play it with factories in the U.S. Because what Trump is trying to do, just manage these companies and impose these high tariffs to try to force them to do, is, first of all, it's going to backfire. It's not even going to work. All these companies that Trump wants to invest billions of dollars in building U.S. factories, by the time these factories are finished, he's not going to be president. And none of these tariffs were passed by Congress. They're all in there by executive order. So what are the odds that the next president is going to reissue that same order? I mean, a lot of times the president comes in, he gets rid of all the executive orders of his predecessor. So why are you going to invest billions of dollars on factories you may never need? Because if the tariffs go away, then what's the point of that factory? But so people are not going to make the investment without the certainty. And even if they had to make that investment, where is the money going to come from to do it? Where is the capital going to come from to do it? Especially with these massive budget deficits. It's not just, privatizing Fannie and Freddie. That's a mistake. Or, the shakedown of NVIDIA or MDA, or what Trump has been doing with crypto and encouraging all this reckless gambling in the U.S. At the expense of real capital investment. But one of the worst things that Trump has done was to not only sign the big, beautiful bill, but to actively cram it down the throats of the opposition in the Republican Party. It's not that the big, beautiful bill just showed up on Trump's desk and he put his John Hancock on it. It came to his desk because he wanted it. Trump wanted that big, beautiful bill the way it was. He did not challenge Congress to do the right thing. He did not say, send me a balanced budget. Send me a budget that reduces the size of government, that makes government smaller. Send me a fiscally responsible budget so I can sign it. He asked for that budget. He asked for those huge deficits. He demanded those huge deficits, and that's exactly what he got. So if he really wants America to invest in the infrastructure that's necessary to make the things that we now import, the only way to do that is to free up the capital. The government has to stop sucking up all that capital with these trade deficits. In Econ 101, we called it, or they called it, crowding out. And that is exactly what the U.S. government is doing. It's crowding out the private investment that we need to build these factories and make these products. That's why we rely on the rest of the world to do it for us. But another thing that we've relied on the rest of the world for, because we've already crowded out our own shallow savings pool, is to finance these deficits. And that is what is coming to an end. The world is not going to be financing our deficits, our budget deficits, our trade deficits. They're not going to be recycling their trade surpluses into U.S. treasuries, into U.S. stocks. They are actually going to be withdrawing the money they already put in, right? The giant sucking sound that you hear, right, which they used to talk about, I think it was Ross Perot, whoever it was, talking about NAFTA and the giant sucking sound of jobs leaving America. Well, now the giant sucking sound is going to be capital leaving America, right? Trump thinks these trade tariffs are going to cause capital to come to America. Capital is going to flee from America. It's going to be sucked out of our bond market, of our stock market, of the dollar. And where are you going to see that? You're seeing it now in gold. You're seeing it in the gold stocks. You're seeing it in the dramatic outperformance of foreign equities over U.S. equities. And these trends are going to continue. And that is why I'm just, so strong on today's podcast. I really want to make sure that my audience is positioned. And, the most frustrating part about it, this is like going to be probably the best year I've had as a portfolio manager. I didn't start managing money for a fee up until about 2010, 2011 timeframe. Before that, I ran my company, Euro Pacific Capital, which I don't really own anymore. I have Euro Pacific Asset Management, but Euro Pacific Capital was a broker dealer. And so I didn't have any fee-based investments. I didn't manage money for a fee. What I did and what my brokers did is we recommended stocks. And when our customers bought those stocks, we charged a commission, right? And so the stocks that I was recommending, because I pretty much had the same philosophy in the late 1990s, I saw the stock market bubble, the dot-com bubble. I saw an overvalued dollar. And so I wanted to buy foreign stocks, gold stocks, energy stocks. And I was underperforming dramatically my competitors in the stock market, other brokers who were buying the dot-coms, So I had a tough time in 1997, 1998, 1999, but things turned in my direction in a big way in 2000, 2001, when the dot-com bubble popped, and I had a phenomenal 10-year run. We made a tremendous amount of money. I mean, just insane money. Gold, right, went from 300 to 1900. Oil went from, I forget, I think it was under $20, but it got to over 140 in 2008, right? I had all these oil stocks, the dollar index went from like 120 down to 70, right? Literally, like the Australian dollar doubled, the New Zealand dollar doubled, right? The euro doubled. The euro went from like 80 cents to $1.60, right? I had all these foreign stocks, I had emerging markets, energy stocks, gold stock. I mean, I killed it, right, in the market. But I didn't have a track record because I wasn't managing the portfolios, right? I was just a broker. And so there was no way to track the returns, right? Yeah, I had a tough time in 2008. All my stocks went down like everything else, but then they all came roaring back in 2009 and 2010 it was 2011 where, everything kind of topped. But my best years were 2003, 2004, 2005, 2006. All those years were phenomenal. And then 2007, I had the subprime short. Problem was not that many of my clients participated in that because it was set up as a hedge fund. And so a lot of people didn't get involved and they missed out on the subprime short. But they had great returns in '07 on their other stocks. But when I started managing money in 2011, 2012, that was when the U.S. market bottomed relative to foreign markets. Foreign markets have been dead. Gold stocks have been dead. Everything that I've been doing, right, has underperformed until very recently. I mean, I had a few years, like 2016 was a phenomenal year, but overall, over that extended time period, people were better off in the U.S. stock market. They were better off, in tech stocks. But this year, clearly, I think this trend is over. And I think a lot of the returns that I had been anticipating earning years earlier are going to be earned now and in the years that are following. But what's frustrating is last year, 2024, was my worst year as a manager, not performance-wise. I mean, my gold fund was up 8% last year. I mean, it's not a disaster. I mean, people made money, right? It was up 8%. But I had more money taken out of that fund than in any year that it's existed. In fact, I had net redemptions. People were taking money out of my mutual funds and out of my separately managed accounts every quarter last year. Every quarter. Instead of sending me money, people were taking money away. And the worst year, right, or the worst quarter was the fourth quarter. After Donald Trump won, there were a lot of clients that just sold my funds and took money out of asset management, out of the accounts that I manage, because we have separately managed accounts and then we have funds, right? So people were withdrawing their money because they wanted to invest more heavily in the U.S. at the peak of this bubble. And Donald Trump caused a lot of people to think, this is great for America, right? America is going to boom. And so I want to invest in America. The opposite has happened. In fact, if you look at the worst performing U.S. stock market index year to date, it's the Russell 2000. And that's the one that is the most U.S. centric, because the S&P and the NASDAQ have a lot of multinational companies. But the Russell 2000 is more of a pure play on the domestic economy. And that's the worst of the U.S. stock market indexes. But the best thing people could have done after Trump won was to sell their U.S. stocks and buy foreign stocks. In fact, and the best stocks they could have bought were gold stocks. And those are the ones that they wanted to sell the most. So it was very unfortunate that happened. But I said at the time on this podcast that I thought it was a great contrarian indicator that I was seeing all this money coming out of my funds. I said that must be a great buying opportunity, a great contrarian indicator that if the public is decided to throw in the towel, that's when you want to step into the ring. And I feel bad for the people that bailed out. They've already missed out on these great returns so far in 2025, but I think they're going to miss out on a lot more. In fact, if you happen to be one of those clients who got out of my funds last year, get back in. I mean, it's not too late to fix that mistake. It's an even bigger mistake if you don't correct it. Because I think, again, we're still early in this game. I mean, if it was a baseball game, we're at the top of the first inning in this game, and it's probably going to go into extra innings. So you have a lot of time to admit that you made a mistake and then correct it before it becomes a catastrophic mistake. Anyway, that's it for today's podcast. Again, I'm back in my studio. I am most likely going to be doing more frequent podcasts than I was doing when I was on vacation. And I do think that the second half of the year is going to end up being a lot more interesting in the markets, and I think a lot more profitable. Not that the first half of the year wasn't extremely profitable, but I think my strategies could do even better in the back half of the year, particularly in the fourth quarter, when things might really start come to a head for the U.S. dollar and the U.S. economy. So obviously, as that starts to happen, I'm going to be, have more to talk about and have more frequent podcasts. But in the meantime, if you like this one, don't forget to like it, give it a thumbs up, make a comment, follow me on X if you're not a subscriber. I still haven't been able to move above 595,000. I still can't get there on YouTube. It is a slow grind trying to add YouTube subscribers. So help me out. I'm still trying to hit that elusive 600,000 YouTube subscribers. Oh, and also, if you're not reading the newsletters, make sure and subscribe to my newsletter at shiftsovereign.com. We've got a free newsletter. You get 2 or 3, I think, every week coming into your inbox. I really look forward to reading those myself. Most of them are written by my partner, James Hickman, used to go by Simon Black, but I really look forward to those articles. They're extremely insightful. We see eye to eye on just about everything, which is why we're partners. And so I encourage you. We also have a paid letter as well that you can sign up for. Give it a free try. And if you like it, which I think you will, you can continue. I almost forgot. I want to plug a couple of my upcoming appearances. I am going to be in the Orlando Money Show, October 16th to the 18th. So if you're in the area, or if you're not, you can certainly fly down to Orlando and join us at that conference. They have a special link, schiff.moneyshow.com. If you want to attend, you do have to buy a ticket. They're not expensive. I forget exactly what they cost, but you can register at schiff.moneyshow.com. And also, a couple of weeks later, I will be in New Orleans for the Gold Conference. That's November 2nd through the 5th. Again, you got to go to neworleansconference.com. I don't have a special link yet, but you can go up there and you can register. I think it's going to be one hell of a conference this year. It's going to be the 51st conference, but this has been a huge move in the price of gold since last November. Remember, we were still struggling to get above 2,000 when they had the New Orleans conference in November 2024. You know, we could be closer to 4,000 by the time we get to November 2025. So it should be a very exciting conference. And again, I love the New Orleans conference. It's one of the few conferences that I go to where I care about what the other speakers have to say. And I actually take time to listen to their presentations. A lot of times I go to conferences and I just, I give my talks and then that's it. But when I go to New Orleans, I always pay attention because there's a lot of people there whose opinions I value and I want to hear what they have to say. So it's a great conference. I love being in New Orleans as well. They've got great music. They've got great food. So if you haven't been there, and even if you have, you could join me. Oh, and one other thing that I forgot, we totally redid between the last 2 podcasts, the website at Schiff Gold. So we really improved the back-end functionality of the shopping cart. So I encourage everybody, before Trump slaps some tariffs on, you never know with this administration when they could put tariffs on gold, and who knows what they're going to do. But right now there's no tariffs. And I would go to Schiff Gold and buy some gold and silver. I mean, we've got some specials. If you look at the front of the website, you've got my picks, and there's a lot of times we come up with some special deals. But try the shopping cart. Even if you normally work with a sales representative, give it a shot. I think you'll really enjoy the functionality now. It's very seamless. It's very quick. It's easy just to fill up your shopping cart with whatever gold and silver products you want. 24 hours a day, 7 days a week. There are live prices on that site, so you can, buy whenever you want. You don't have to talk to a person. I mean, we've got great guys to help you if you need to talk to a specialist. But if you can do it yourself, you're going to get a fantastic price on our site. You can go in there and just, fill up your shopping cart and check out. So if you haven't done that, give it a shot. I think we're going to have another big week in the precious metals. I'm still looking for silver, which again is around 38.5, 38.40. We got above 39 a couple of weeks ago. Once we get above 40, I think we're going to make a beeline to 50. 50 might be a little bit of resistance, but once we break through it, I think we could be closer to $100 an ounce than 50 on silver in short order. So you want to load up on these products, not only before the price of silver goes up, but before the premiums on the products go up, because I think they're both going to go higher. The same thing with gold. I think gold, once it breaks through 3,500, we're going to go straight up to 4,000. It could get there very quickly. A lot of people have been reluctant to buy gold and silver because they think the prices are high. They're not high in an absolute basis. Sure, they're higher than they've been. But again, I mentioned gold in 2011 was 1,900. We're only up 80% in 14 years. I mean, that's not that much when you consider inflation. Look, when I was in Connecticut, I had to make some repairs on the swimming pool at the house. I haven't really done any repairs. The house was built in 2002. So that's when the swimming pool was put in. And I bought it in 2009. And I didn't do anything. I put a fence around it for a while when I had young children to keep the kids out of the pool. But I didn't really repair it. And so I had this contractor there from a pool company to repair the pool. And it's costing me like $100,000 just to repair it, not make it better than it was. I'm not putting anything fancy. I'm just fixing what's already there, but which, it needs to be repaired, right? Cracks, leaks, just different things, filters, right? There's no new, I'm not adding fountains or fancy tile. I'm just fixing it. And it's costing me more to fix it than it initially cost to build the entire pool. But I asked the guy that's running the pool company, I said, I couldn't believe that it was this expensive. And he said, well, it would cost you, $250,000 to build it now, but he said that everything related to pools has doubled in the last 5 years. So whatever a pool cost 5 years ago, it's twice as much today. If you had to fix your pool 5 years ago, it's twice as much to fix it today. So that's 100% increase in the price of a pool in 5 years. Yet the price of gold is only up 80% in 14 years. So gold is not expensive. You got to get used to it. The dollar is losing its value. That's why you need $3,400 to buy 1 ounce of gold. You used to only need $20 to buy an ounce of gold. From the birth of the Republic in 1789 until 1933, you only needed $20 to buy an ounce of gold. Up until from 1933 till 1970, you only needed $35 to buy an ounce of gold. Now you need $3,400. What's changed? Not gold. Gold is exactly the same. It's one of the few things that never changes, right? A car today is not the same thing as a car in 1933. An airplane, a telephone, right? All kinds of things get better. Gold is exactly the same. If you have an ounce of gold today, it's the exact same ounce that someone had 100 years ago. In fact, people have those coins, right? They still own them. So the gold hasn't changed. It's exactly the way it was. All that's changed is the dollar. The dollar has lost so much value that you now need 3,400 of them to buy 1 ounce of gold. Well, the dollar is going to be losing value much faster in the future than it has in the past. In fact, I think it's going to be exponential how much value and how quickly the dollar is going to lose it. So that means you're going to need more and more dollars. You'll need $5,000. You'll need $10,000. You'll need $20,000 to buy an ounce of gold. And again, gold is not getting more expensive. The dollar is getting less valuable. So the longer you hold on to your dollars, the more gold you're going to lose, because that means you'll be able to buy less gold the longer you hold those dollars. That's what foreign central banks have already figured out. It is a race to get out of the dollar. And this is one race that you can't afford to lose. Bye for now.